All right, everyone. I hope you're enjoying your lunch. Please continue with dessert. We'll just be introducing our final speaker for this weekend symposium. Before I make this introduction, I just wanted to say thank you for coming. I speak for everyone at the Griswold Center to say how happy we are to be back in person and to see all of you face-to-face instead of on Zoom. And thank you for your support coming to our events the last 2 years, even though they were on Zoom. It meant a lot to us to still see you in some capacity, even if it couldn't be in person, due to public health concerns. So hopefully this is the first of a long return of in-person symposia and other events. So for our final event for the symposium this weekend, we're really excited. We couldn't imagine a better person to talk on the subject of navigating the uncertainty of macroeconomic policy post-pandemic, or during such geopolitical uncertainty as John Williams. John is the president and CEO of the Federal Reserve Bank of New York. He came to New York after a long and distinguished career at the San Francisco Fed, where from 2011 to 2018, he was the president and CEO of the San Francisco Fed as well. In his capacity as Federal Reserve Bank President of New York, he serves as the vice chairman and a permanent member of the Federal Open Market Committee. John's research focuses on monetary policy under uncertainty, kind of a perfect research focus given our interests today. So, John, take it away. You'll go for as long as you want, and then we'll start with some questions and open it up to the audience.
Well, good afternoon, everyone, and it's a great pleasure to be here at Princeton University and to attend an event like this actually in person. This is my first in-person event outside of the New York Fed since the pandemic, and it's great to see so many people, esteemed colleagues in person here today. Now, we've had a lot of good discussions yesterday, starting with Carmen's remarks yesterday and Mark Sandy and the panel already, and I heard a lot of discussion about what the Fed should do or what the Fed's gonna do, and so that was interesting to hear that. I did take notes. Whenever I visit a college campus, I am reminded of some of the concepts that I learned as a student, and they can become more meaningful over time, often in surprising ways. So I've thought of that as I've reflected on the significant challenges that we face today, and that's the ongoing pandemic and all the effects of that and the Russian invasion of Ukraine. In addition to the staggering human suffering, these events are imposing considerable economic and financial hardships around the world. If we think back on what many of us learned in statistics about factor analysis, the pandemic and the Russian invasion can be seen as factors that are have common effects across countries, but they're also idiosyncratic components that have distinct effects for the US economy. So I'll talk more about that today, as well as give you my views on inflation and the economic outlook. But I want to say at the outset that we at the Federal Reserve are committed to fulfilling our dual mandate of price stability and maximum employment. With inflation too high, we're focused on restoring price stability while maintaining a strong labor market. Now, this is the perfect time to give the usual Fed disclaimer, so I will. Everything I say reflects my own views and not necessarily those of the Federal Open Market Committee or anyone else in the Federal Reserve System. Now, it's striking to think back to 2 years ago. The US economy is reaching the trough of the COVID-19 recession, and back then we were living through unprecedented lockdowns. And we had no way of knowing at that time that this would be the shortest recession on record, or that the rebound would be so dramatic. Now, if we think about the global pandemic as a common factor, shutdowns, contractions, and rapid rebounds were the shared impacts across countries around the world. But so were supply chain bottlenecks, shortages in semiconductors, and backlogs at ports, issues we grapple with today and we discussed earlier. And just like the United States, other countries have experienced imbalances in demand. Since the initial lockdowns, people have spent more of their money on electronics, on cars, on furniture, and less on entertainment, travel, and restaurants. Many nations also showed considerable resilience of economic activity through the recent Omicron wave, but global risks remain. The BA.2 variant is now fueling a rise in cases in some countries, including China, Hong Kong, and the United Kingdom, and their experience bears close monitoring. In addition, of course, the war in Ukraine poses significant risks to food and energy prices, as well as global economic growth. So going back to my analogy of factor analysis, there are idiosyncratic components of the pandemic. So I think it's important to note areas where we've had a uniquely American experience in the COVID-19 recovery. First, as we again discussed earlier today, the amount of direct fiscal support in the United States was much larger than what most other countries provided. This created a sizable cushion for many households, giving them the ability to maintain spending through the pandemic and as inflation has started to rise. In addition, the U.S. labor market has recovered strongly since the recession trough, and labor shortages here have become more acute than in many other countries. Now, part of the reason for the shortage of labor is that the U.S. labor force participation rate is still about a percentage point below its level prior to the pandemic, in what has now become known as the Great Resignation. A portion of this decline reflects longer-term trends related to the aging of the population, but some have left the labor market because they needed to be home to care for young children or elderly relatives. Others didn't want to risk exposure to COVID in the workplace, and many simply chose early retirement. Despite the challenges presented by the Omicron wave earlier this year, the unemployment rate fell to 3.6% in March. That brings it in line with the very low levels that we saw before the pandemic. And with low unemployment, solid wage growth, ample job openings, all indicators show that the strength of the labor market is at a level consistent with my view of maximum employment. The other side of our mandate, of course, is price stability, and this is where our greatest challenge now lies. Inflation is far too high. In February, inflation as measured by the Personal Consumption Expenditures Price Index was nearly 6.5%. And high inflation is a key concern in many countries around the world. Even before Russia's invasion of Ukraine, the rapid global economic rebound had driven up prices for oil and many other commodities. Higher inflation is especially detrimental for those who are least able to meet the growing cost of essentials like food, housing, and transportation. The war in Ukraine and the global response present even greater challenges and uncertainty. For example, Russia and Ukraine are large exporters of key materials, including neon, palladium, and platinum. And those materials are used in the production of a wide variety of products, from auto parts to computer chips. And even before the war, manufacturers were confronting shortages of important inputs. And further disruptions to these key products could create spillovers to economies around the world. But there are differences in the ways in which countries are experiencing inflation today. In the United States, we're seeing elevated inflation across many categories of goods and services. Meanwhile, in Europe, which is heavily dependent on Russia for energy, rising prices of oil and natural gas are the biggest concern. And in the Middle East, there are fears of a wheat shortage, given the region's reliance on wheat from Russia and Ukraine. The one bright spot regarding inflation is that longer-run inflation expectations remain well anchored. The anchoring is seen both in market-based measures of expected inflation and in surveys of households and economists. So I am now going to talk about the New York Fed survey of consumer expectations, which is something that we've been doing since 2013. According to we've been fielding special survey questions on 5-year ahead inflation expectations. So this is households, regular people being surveyed about what they think inflation will be 5 years from today. So we started these special surveys back in 2019 before the pandemic. And what's striking about this is that these expectations have hardly budged since the beginning of the pandemic. In addition, we've studied how inflation expectations have been behaving during the period of the pandemic. And what we found is that the pass-through of inflation surprises to revisions in 3-year ahead inflation expectations, a question we ask every month, is about half as large as it was before 2020. That is, these medium-term inflation expectations in our survey are less responsive to inflation shocks than they were before the pandemic. Faced with rising inflation but otherwise strong economies, the Federal Reserve and many other central banks have been moving away from the extraordinarily accommodative stances they took back in early 2020. Last year, many emerging market central banks raised their policy rates, and in December, the Bank of England followed suit, followed by the Bank of Canada this March. So closer to home, the FOMC decided a little over 2 weeks ago to raise the target range for the federal funds rate by 1/4 percentage point. The FOMC's decision to start the process of reducing monetary support for the economy reflected the strength and resilience the economy has displayed early this year, as well as the very high inflation readings of the past several months. In addition to the decision to raise the target range for the federal funds rate, the FOMC communicated 2 important messages about the likely future course of monetary policy. First, the FOMC indicated it expects that ongoing increases in the target range will be appropriate. And although the FOMC did not make any decisions about future policy actions, the summary of economic projections is informative regarding the thinking of the committee at the time of the March meeting. The meeting assessment of the appropriate level of the federal funds rate at the end of next year is expected to be somewhat above the meeting assessment of its longer run level in particular. Of course, these are only forecasts. Uncertainty about the economic outlook remains extraordinarily high, and risks to the inflation outlook are particularly acute. One of the things we've learned from the pandemic is expect the unexpected, and the actual path for policy will depend on the evolution of economic conditions, the outlook, and risks to the achievement of our price stability and maximum employment goals. Second, the FOMC indicated it expects to decide at a coming meeting when to begin reducing its holdings of securities. This process will be based on the FOMC's principles for reducing the size of the balance sheet that was released back in January. And a key principle is to reduce the balance sheet in a predictable manner, primarily by adjusting the amounts reinvested in principal payments received from securities held in the system open market account. I expect this process of reducing the size of the balance sheet can begin as soon as the May FOMC meeting. Our monetary policy actions, importantly combined with those of other countries, will help bring demand for labor and products in closer alignment with the available supply. As this reduction in demand-induced price pressures takes effect and supply constraints gradually ease, I anticipate inflation readings will begin to decline later this year, although this process will take time to fully play out. For 2022 as a whole, I expect PCE inflation to be around 4%, to decline to about 2.5% next year, before returning close to our 2% longer run goal by 2024. So these actions should enable us to manage the proverbial soft landing that was the topic of discussion all this day so far, in a way that maintains a sustained strong economy and labor market. Both are well positioned to withstand tighter monetary policy. In fact, I expect the economy to continue to grow this year, for the unemployment rate to remain close to its current level. These are uncertain times, and the policy questions we face are challenging, but we have learned the lessons of high inflation from the past. Price stability is essential for sustained economic prosperity, and we're strongly committed to using our tools as needed to achieve our price stability and maximum employment goals. Thank you, and I look forward to the questions.
In passing, the Russian invasion of Ukraine and what's now, I think, a 6-week war, what do you think of as, what is your outlook? I know these are very uncertain times in both the short and the long run in terms of the macro effects of the Russia-Ukraine situation.
So the first thing I will agree with is he's highly uncertain. I can't remember whether it was Mark who said that earlier today, but I think a lot of the direct effects we're seeing in asset prices, oil prices, commodity prices. So we've seen those effects, and I mentioned the food and energy effects on inflation, but maybe more importantly on what's happening around the world for those where food and energy is a big part of their spending basket, something that Carmen highlighted yesterday. So my view is it does raise the near-term inflation data, obviously, and the risks. And in terms of the U.S. GDP outlook, I actually think that that's probably a relatively small effect because, of course, we are a much bigger producer of energy than we used to be. So these kind of rules of thumb need to be updated for that. So I see it primarily for the U.S. outlook is in inflation. But look at Europe or other regions, I think it's a much more of a mixed bag where it's clearly going to hit them in terms of economic growth, because a huge increase in energy prices, which is like a tax on consumers. The other thing I've been looking for, but really hasn't happened, is to see global risk sentiment change around this. We talked already today quite a bit about the bond market and the stock market and how they're kind of responding differently. But I think that's one of the risks. If there's a sense of this situation becoming worse, even worse, I would say, that could lead to a more negative sentiment in financial markets, which we haven't seen really yet. So I do see this as an important factor in terms of the inflation and economic outlook, but probably even more so in terms of uncertainty. Longer term, I think it really is mostly about the geopolitical constellation of the global economic, political, and financial systems. I mean, it's been remarkable. First of all, that I think Mark said he predicted COVID, but did not predict the Russian invasion of Ukraine. So this is a very unprecedented type of event, but also the response from the allied countries, I think, has been unprecedented with the speed and the types of action. So, we're going to see how this evolves over time, but definitely something that I think will have a lasting impact.
One scenario of the outcome of this war is that the world gets more divided again. Instead of globalization, you have the U.S. and Europe, et cetera, China, Asia, and then Central Asia, Russia. How would that affect the U.S. economy? It seems like it's less efficient, et cetera. What are the long-term impacts if it went that way?
Well, I think it's a hugely different situation than you thought about the Cold War, because back then, China's economy, Russia's economy were tiny, compared to the global economy. Now, China's economy is obviously enormous today, and highly integrated into the global economic system. So I think that when you contemplate these things, it's not about going back to some past where China and Russia were basically in kind of an autarky between them with the rest of the system, but China obviously is hugely integrated with our economies. So I think that this gets to this issue that I was kind of ending with it. I think there are in a bad scenario that there are long-lasting kind of pullback from international trade or pullback from full economic integration, which would have enormous effects, even in the short run, obviously, but even in the long run in terms of all the gains from globalization, the benefits of, that accumulated for decades for economic growth around the world. Hopefully it's not in China's interest, obviously, for that to happen. It's not in anyone's interest for that to happen, so we hope to avoid that. But I do think that that's could be a fundamental reordering of economic relationships that would undo many of the positive benefits that we got for decades in terms of productivity growth and lower costs for goods for consumers.
Over here, John. So if we think about the COVID fiscal spending as a one-time shock, completely conventional macro models of the sort that inform monetary policy choices say that part of an optimal response to that is to allow inflation to rise and cushion against having to raise distorting taxes and so forth. How, if at all, does that kind of reasoning fit into the way that the Fed is thinking about its fight against inflation?
Well, we have, we view the 2% inflation target in the long run as being at the core of our understanding of our dual mandate, both in terms of maximum employment price stability. I often get asked, is the 2% inflation target, or is that just picked at random? Of course, we think that 2% inflation is both achieves price stability but supports maximum employment by creating ability to adjust to shocks. So I think my view on this is we need to stay focused on achieving our 2% objective over time. Obviously, fiscal policy is part of the equation that affects demand, it affects the economy. But really, if we focus on getting the 2% inflation, achieving that goal consistently over time, then that actually supports a strong economy. It supports all of our objectives. And I would just take fiscal policy, kind of the considerations that the Treasury and the government have to take. That they have to make their decisions, and we'll focus. We're an independent central bank on achieving our goals. So I don't see this as the way you framed it, is like, how does monetary policy respond to kind of fiscal policy? To me, it's fiscal policy shapes the economic environment we operate in, but our job is obviously to achieve our goals.
Two questions. One, just as a follow-up to that, does that mean reach the target patiently, or if it's not by the end of 2023, then one has to be more aggressive? So if you're not at 2.5%, for example, should the Fed be more aggressive? And then, given the huge spectrum of recession from 35% from Mark to 85%, where do you stand? Again, your own personal views, obviously, we understand that.
I have said, I think throughout my career, that monetary policy needs to be data dependent. We are in a data dependent mode. A lot of discussion about the pivots this morning. I mean, from my perspective, the shift in my own view of where policy needs to be over the next few years has moved significantly in the last 6 months. And it's because of what we've seen in the data. And I know we all talk about the high inflation because that is the biggest challenge we have today and the thing we are most focused on. But the recovery has been remarkable. The unemployment rate is basically where it was at the beginning of the pandemic, and we've seen labor force participation for prime age, men and women rebound considerably in a way that we were hoping to see. So we're seeing a lot of strength in the maximum employment side, but we obviously have seen the higher inflation. So for me, it's about data dependence. It's about adjusting policy as the facts change and as the outlook and the risks change. And so to answer your question, well, where does policy go from here? Well, there's a baseline view back in March. You see that in the economic projections, and then as the data flow in and the risks to the outlook change, then the policy path that comes, that's appropriate is our language, will change as well. And that's just good monetary policy. It's not the Taylor rule or a specific formula. It is just adapting to a changing environment. And very importantly, I know, Chair Powell emphasizes this very much, and I agree with this, is a lot of this is also risk management. It was said at the beginning that, and I know this is from my bio, that my research focused on monetary policy under uncertainty. I guess I made a decision early in my career. Should I do monetary policy under certainty, or should I do monetary policy under uncertainty? Well, for the people who know monetary policy, where there are many experts in this room, there actually is a big literature on monetary policy under certainty. I've never seen an applicability of that to the real world, but there is that study. So we just need to be data dependent. We need to communicate. Dave, I'm losing where David is in the room, but okay, I do think that the dot plots, I'm going to take a stand here that others may disagree with, but I do think the better we are able to communicate how we're thinking about the economy, whether we're right or wrong, whether our forecasts end up being proven inaccurate or accurate, the better we're able to communicate how we're thinking about the economy, how we're going to achieve our goals, and the policy actions that we plan to take, the more effective monetary policy is at achieving those goals. We need to be able to be flexible and nimble as the facts change, going back to Keynes's famous quote, we need to change our actions, but the better we are able to explain what good looks like, how we think we're going to get there, and reiterate that we're going to change course or change our decisions based on the data, I think that makes monetary policy more effective. If you look at where, the topic of the day is the 2-year, 10-year yield curve or spread. And what do you see in the 2-year yield? What you see in the 2-year yield or the futures markets or whatever is you see, Fed communication in action. I mean, we've done one rate increase, but by, I think, clearly communicating where we're going, what we're trying to achieve, and I'm not saying the markets have it exactly right or wrong, but you're seeing financial conditions move pretty dramatically in the last 4 months, and that's showing up in financial conditions that actually affect consumers, businesses, decisions, and much more broadly. So I think that, better communication, transparency, and the ability to shift as the data change is really going to help us be successful. Now you asked this, what? Right, so I have a paper from way back. I was going to mention this earlier, that Glenn Ruderbush and I did in 2009, and we compared the yield curve. We did the Fed funds 10-year model to economist forecasts. And without me jumping into the debate about the yield curve as a predictor, the one thing I did learn from this research is economists can't predict recessions. And so this is not, it's what was striking about our result was the yield curve model was invented at the New York Fed in the late 80s. And we took that model and we did we took that model and looked at the 90s and 2000s. And also, after it was in the public domain. And we found, and then we compared it to the survey of professional forecasters about economists' ability to predict recessions. We found that except in the current quarter, economists can actually predict recessions pretty well that have already happened. But the yield curve beats everybody at 3 to 4 quarters. My point on this is not that the yield curve is the answer, or I think we had a great discussion of that. I just think it's very challenging, not just for us Fed economists, but for everybody to do that. So I think that, from my perspective, we need to be focused on taking what we can do, what we see, what the decisions we can make to best thread that needle to get inflation down in the next few years, get it back down to 2%, while doing the least, trying not to disrupt or interfere with a strong economy. Shocks will happen. We've experienced that, and we need to be able to respond to that. But I think that for all the reasons that Mark and many others talked about, I think that there is a way to get there. It's just going to be challenging. So I'm not going to give a probability.
I can agree more about the 2% inflation target. Not surprising, ex-central banker. But it's a strange thing that to see in real time when inflation is far exceeding the target, that expectations are holding as well as they are, and in fact that's the product of many years of credibility. And so, and I understand that you need to be data dependent, but you have to have a paradigm in which you interpret the data. And one could argue, with all humility, because I've been in the same seat, that we got the demand side probably better than we got the supply side when we're thinking about it. And the world we thought we were in pre-COVID was kind of a deficient demand world, and the whole problem was to get inflation back up to target. And so my question to you is going forward, do you think we're going to go back to this deficient demand world? And then secondly, is there going to be a higher kind of role for supply to be more active in this whole process? I mean, usually we look at supply as, production function, potential output, that kind of stuff, and it seems to have been more nuanced. And the reason I'm asking is because we've got, we do have technological change that should help put downward pressure, but the demographic change, the transition to a low carbon economy, changing composition of demand for stuff that's just inherently in short supply, seems to me that could change the equation. So how do you see that supply side going forward as more of a structural reality?
Well, I guess I've always thought that the supply side was a really important part of this. It's interesting because back when I was starting out of the Fed in the 90s, the topic in the late 90s, as everyone knows who knows about Alan Greenspan's leadership of the Fed at that time, the issue was the productivity acceleration. And how is the supply side of the economy changing not only productivity growth, but kind of everything about the economy, and what does it mean for monetary policy? And wait a minute, how far were we? 36 minutes in, and that was the period that led to the creation of the Laubach-Williams R-star method. So the 36 minutes is the longest I've ever gone talking without mentioning R-star, by the way. But it actually is about supply and demand. It's about the equal, what's affecting the supply side of the economy, productivity growth, demographics, lots of other things. All obviously what's affecting demand, and they're interconnected, right? It's not Say's law, but supply depends on demand, and demand depends on supply. So I think these are really important issues. There's a thing that, I think we realized over these decades, since the 90s, since that period, that we need to understand the supply side elements just as much as the demand. We had the debate forever I'm sure Bill remembers this about labor force participation trends in the last recovery and understanding that and how high labor force participation would get. And that was one of those things where we had not only models and data analysis, but the things behave differently than a lot of people expected. So, and on productivity, clearly this has been a big issue. We had Nick Bloom talk at the New York Fed a couple days ago about the future of New York City, which will be absolutely fantastic, by the way. So whenever you hear the talk about the big cities' best days are behind them, I don't agree. But one of the things is, I think remote work is going to be. I was talking to Mark about this. It's probably a game changer on that too. I mean, it opens up opportunities for more people to join the labor market who couldn't otherwise, or would find it difficult to work, especially if they have some kind of challenges, getting to the workplace, or have kids or other people they're taking care of. Nick also mentioned that according to their surveys, that people who are in hybrid models, 2 to 3 days a week, their own answers to survey questions is, to them, the value of being able to go from full-time in the office to a hybrid is equal to an 8% pay increase, something I'm going to take back to the bank when I talk to employees. But you think about that, that's like first order. Like, you're actually changing kind of the ability of the economy to produce and the way it produces things. So I think there's a lot of opportunities there. The one thing that's hard on the supply side is these things tend to either move slowly, like demographics, or they move in ways that are hard to predict, and that's, I think, gets back to the uncertainty part. You have to kind of be humble and realize that there could be changes around that you didn't expect. We're going through this in the last 6-9 months. There's no question about this. My prior 9 months ago is we would see labor force participation, broadly, after adjusting for demographics, get back to something like we saw in 2018-19. I mean, there's nothing fundamentally different in a post-COVID world than the pre-COVID world. And then once but we've been watching that data. Clearly, this is going to take longer. I'm still optimistic about labor force participation for people getting back once they're able. They got their kids back in school on a regular basis. They're able to. Daycare is more available. But those are supply side factors that clearly are taking a lot longer than I would have thought before, and that has to be part of the equation. But I think the big question really is has COVID increased trend productivity, increased labor force participations, not by a half a tenth of a percentage point, but maybe, like Nick was arguing, potentially, full percentage points on labor force participation, for example.
Two questions. One is about the monetary policy framework of August 2020, average inflation targeting. Is this still alive, or is it dead?
Yes.
If it's alive, should we expect a deflation after things? So how should we interpret that? And my second question is about the international global role of the dollar. How do you see this affected through the sanctions as a reserve currency? And how do you see the high inflation impairing the global role of the dollar? Or do you think that will just go by without impact?
With the first one again, quick.
The average inflation targeting
Yes.
is still alive.
Yeah. Okay. So I'm going to. I think I try to be as clear as I can. So we it's called average inflation targeting by many people. I think pretty much everybody. But of course, average inflation targeting means different things, depending on how you formulate it. The thing that the FOMC did very clearly was not say that we're doing some kind of explicit makeup strategy that would be close to price level targeting or some formulaic average inflation targeting. Thomas Mertens and I, in many papers over the years, you can, if the definition of average inflation targeting is that the mean inflation rate, or, broadly defined, is equal to the target, you could have that be an unconditional mean versus a mean over the cycle or something. So the FOMC decided we're not doing explicit makeup strategies like price level targeting or a specific average. So there's no need in the framework to try to, if you have high inflation, to try to create deflation to get some average over a certain time frame. So what is success? And you said, well, wait a minute, you just kind of moved away from like a test. Well, what is the test? The test is very clear in our consensus statement because we say it over and over again. It's anchoring inflation expectations at a level consistent with a 2% inflation. It's delivering 2%, consistently over, longer periods of time. So to me, it's the inflation expectations thing. So if we can't, we have to be focused on making sure the public, markets, and everybody understands that 2% is where we're going, and that's what we want it to be on average. So that's why I follow that a lot, because we're not doing some mathematical average of average inflation, but really looking at making sure that the expectation of inflation down the road is equal to 2%. And you know, I've seen that in the U.S. and of course in many other countries. In fact, you know, a lot of people are commenting that the inflation expectations are a little higher than they were just a few years ago, but that was not, that's a feature, not a bug. Inflation expectations had been drifting down in the latter part of the decade, and now they seem to be levels consistent with a 2% PCE inflation. So the second question you had was the role of the dollar. I mean, obviously, this is a topic that's come up a lot with sanctions. It came up with around sanctions. I think a couple things that I would just comment on that. One is the fact that, you know, the allied countries acted, you know, basically in unison around sanctions, around the actions that were taking place. I think it's incredibly powerful. It's very effective, but it also gets to this issue. This is not about one currency or another. I mean, all of the countries with the major reserve currencies are acting together. So I think that's an important context for this discussion. And the other is that, you know, clearly when you think about the reserve currency role, you get back to where do you want to be when things are bad or when the uncertainty is high and you're protecting from tail risks. And I think that the U.S. dollar has once again proven itself to be a safe haven. It holds its value, and it does actually better than in terms of you know, like bonds during times of stress. Now, obviously, on your point about inflation, we've got to deliver on what I said. We have to get inflation down. We have to get inflation to 2% on a sustained basis to kind of reinforce that good equilibrium that supports the dollar's role. One question that comes up a lot is, you know, well, China and Russia, you know, can obviously, you know, increase their payments, you know, infrastructure, and you could see some of that moving into that realm, which is obviously possible. It's been, you know, thought about or worked on for a long time. But you know, the global financial system still is, you know, mostly outside those countries, and clearly, you know, involves all the Western countries in Europe and Asia and around the world. So I think that can maybe sidestep in certain ways, you know, not needing the dollar, but it doesn't get you into the rest of the world. So my view is still very positive on that the dollar will maintain its very important role.
Let's talk about R-star now. I know it's, as you say, it's unusual for you to speak for so long without speaking about that. The market seems to have exactly your view that we got to get to R-star relatively quickly, meaning neutral rates. That's probably why the market is pricing in 8 rate hikes. How do you think about the R-star concept relative to what the need is now? Namely, do we need to get to R-star as quickly as we can, and then we'll evaluate, and then once we get above, growth will begin to slow down? Or is there also a case that growth could begin to slow down even over the coming quarters before we get to R-star? So in your framework and your work with Thomas, would you say that we got to get to R-star as quickly as we can and then we'll evaluate? Or are you saying, well, maybe we need to take it a little bit slower and figure out whether things are, and mortgage rates are already up 200 basis points, whether things are behaving the way they should, and therefore we maybe don't need to rush to get up to R-star as quickly as we can?
Okay, I have 15 minutes. You know, obviously I do think R-star is an important concept. I do, but it's a longer term concept, right? It's a concept of what the, you know, unconditional or, you know, mean of a real interest, real Fed funds rate is what we do. It's not a short run concept. So to me it is, you know, I know Chair Powell spoke about this at Jackson Hole several years ago. It is a star. We don't know exactly where it is, and maybe it moves over time, which is things that Thomas and I emphasized when we did our original research 20 years ago. So I do think it is a bit of a it's not a North Star, but it's a kind of a concept that I do think of as useful. So let me answer your question. So I do think, you know, real interest rates, you know, nominal interest rates, but really real interest rates are, you know, are very low today, obviously, on the Fed funds rate. And clearly we need to get back to something more like normal or neutral, whatever that means. We need, and you know, the question of do we need to get there immediately? No, we can do this in a sequence of steps. But I do think it's pretty clear, given an unemployment rate of about 3.5% in an economy that's still, I think, got good momentum and inflation that's high, that it doesn't make sense to be in, have the Fed funds rate in a deeply negative space. We want to get it. I think it's appropriate to get it back to more normal levels. So then you ask the question, well, do you want to get back to neutral or around neutral, and then kind of look around and see what do you see there? I understand what you mean, because I do think we need to get closer to neutral, but I do think we need to watch the whole way. So I think that we can, obviously we can. You've seen where market expectations are, where the dot plot was. I mean, there's no question that that's the direction we're moving, is to get back to neutral. Exactly how quickly we do that will, I think, depend on the circumstances that we're facing. But I do think we have to be cognizant of watching the economy and how it evolves during this whole path, and adjust as needed. I go back to my experience of, and this may begin back to an earlier question, that 2018, 2019 is still a memory that I recall, that we were getting back. We got a real funds rate that was slightly positive, close to values of neutral, and the economic expansion started to slow, and there were signs. Though there was a lot of factors obviously going on then, but the economy wasn't going to grow at I think a high rate or solid rate with a real funds rate that was at a traditional value of neutral. So when we entered the pandemic, of course, the funds rate we were well below neutral even then. So I do think that the experience from that is to we got to move to more normal levels. That's the right thing to do. We'll get there. But also be making sure that we're reassessing and reevaluating, not only at the end and look around, but also along the way. I do think that one question will really be driven by how persistent inflation is. Right now we have forecasts. Mark showed his forecast. You've seen our forecast. There's a lot of reasons I expect inflation to come down, but if it does become more embedded in the economy, especially in more services, is if it does start slipping more into inflation expectations, we'll have to respond appropriately to that. My hope right now is that won't happen, but we have to be ready for it. Yes, I can.
45 minutes.
So, I separated cryptocurrencies into three topics. One is, like Bitcoin, things like that. And then there's stable coins, and then there's CBDC, central bank digital currencies. So on CBDC, I'm going to have to set this aside. The Federal Reserve put out a white paper basically explaining, why you would or wouldn't, or what were the benefits of, or possible challenges with a central bank digital currency. Obviously, this is being studied around the world. Central banks are studying this very carefully and very thoroughly, and there's no decisions being made by the Fed right now. This is definitely a study and get feedback on that. So that's set aside. I think on pure crypto, kind of the original cryptocurrencies that are, not backed by any actual, assets, so they're self-referential. I just don't see the public purpose of those as currency or as a payment system. The technology is amazing. I mean, we are studying and learning about blockchain and this for many different purposes that make a lot of sense. So that, I'm not talking about the technology, but I'm talking about like creating a new currency. So what are the problems with it? I mean, I think they're well known. One is it's extremely expensive. It's highly volatile in price given the structure of it, which means it's not a good store of value. Of course, everyone who has bought Bitcoin in the last 5 years says, no, John, it's been a great store of value, but it's not a great store of value for a currency. To use as a payments method. It clearly has issues with anti-money laundering and anti-terrorism issues there that if it were used broadly. And to me, it kind of cannot fundamentally serve the elastic currency needs of a modern economy, which is what central banks are there for. So stablecoin is more fascinating because you could imagine a well-designed stablecoin that is basically fully backed by U.S. treasuries or possibly reserves in a central bank or other completely safe liquid assets, that the technology is used to make it really easy to meet store of value and other kind of needs, and is it properly regulated? It would be kind of like a a treasury money market mutual fund, and it's safe, it's reliable, and it serves a purpose. So I'm probably more positive on a really well-regulated stable coin that is fully backed by true safe reserves, not backed by kind of like a prime money market fund with CP and CDs and things like that, or cryptocurrencies, but one that's backed by a true a dollar. So I think that the President's Working Group was very, I think, appropriately said there are cases for this. We need regulation in the U.S. We also need some legislation, I think, around that. But I could see a future where stable coins, if we had the regulation and legislation, played a role. And I think, technology is transforming the financial system and the financial services and payments. So it's going to do that. I think it's an opportunity if done well. We've all lived through the experience of prime money market mutual funds, that this was filling a need, but unfortunately had some fundamental flaws around financial stability, about breaking the buck. That was exposed in 2008. It was exposed in 2020. We want to learn from that, and as we think about, obviously, with reforms on that, but also on thinking about stable coins and other things. Now, I think the really interesting thing that's happening right now is this technology is showing up in lots of other areas other areas as well, and so I think there'll be a lot of change from that.
Does that mean that you will not be as data dependent when it comes to balance sheet reduction?
Yeah, that's actually a very good nuanced question, because we want to be predictable, we want to be transparent, we want to communicate in advance, but as I said earlier, we also want to be able to adjust and be nimble. If you look at the end of our any kind of principle statement, there's always this last paragraph 5 or 6, depending, says, well, we kind of give ourselves the option to change our plans if circumstances, call for that. I think the idea of the balance sheet reduction plan is, at least during the initial phase, the first major phase, is to have that operate in a very predictable way, that it's just happening in the background. I won't use other expressions to describe it, but just in the background, it's happening there. And obviously the Fed funds rate, as we've said very clearly, is the primary tool of monetary policy. So if you think about the balance sheet doing this, then as economic conditions change, we could modify the Fed funds rate as needed. Obviously, if there was a major change in the economic outlook, we could revisit what we wanted to do on the balance sheet reduction. I think that one issue that will come up at some point in the future, not in the first part of it, is at what point do we bring the reduction of the balance sheet, slow that down and bring that to an end. We've learned from the experience of September 2019, and thank you for those who remind me of that this morning. But that was a period where we saw the challenges when the amount of reserves in the banking system got too low, and money markets became much more volatile, repo markets, and that spilled into the Fed funds rate. So we have committed ourselves at the FOMC to really doing a true ample reserves regime, which should be defined by a situation where movements, short-term shocks to demand supply of reserves are not moving short-term interest rates by a meaningful amount, and therefore really it's the administered rates, the rate on the overnight reverse repo, the interest on reserves, that are really setting the boundaries on how short-term rates behave. But to me, that's kind of what good in the background looks like. There's some adjustments that will have to happen on the way, but any major change would really be because of a significant change in the outlook.
Not planning to use balance sheet reduction to do yield curve control.
No, beyond the fact that we would be reducing the balance sheet over time, that's affecting yields. So I'm going to be careful with affecting yields versus controlling yields. How yields evolve depending on the market conditions, economic outlook, that would be happening on its own. We never did target longer term interest rates throughout this episode. Something other central banks did. Obviously, the Bank of Japan's done, the Reserve Bank of Australia's done, but we've basically taken the view of let's get the quantities where we want them to be in terms of our balance sheet, and the market forces will work to figure out the pricing. One of the advantages of that is we get a lot of information from market pricing, especially on the yield curve. So, we don't want to I know we're influencing it, although there's a big debate about how much the QE does, but it's not that we're targeting a rate.
I don't mean to put you on the spot, but would you mind commenting on the term transitory? Because it seems to me to be a pretty unfortunate term that probably created more confusion for the public than clarity. And I guess a lot of people would say, surely, I guess for us sitting here, for me sitting through those 2-day session, I think we probably had a good plan, and then a bunch of black swan events happened, like the Delta wave, like the Ukrainian war, and it was very unfortunate that we're seeing the inflation level we're seeing now, and it could very well be transitory. But I think in the public's mind, they would say, an average American would say, the economists have no idea what they're doing, however populist or irrational that may be. So how should we communicate to the public, and do you think we should right now retire that term or give it some more time?
I didn't see that term today. This is a tough judgment call. We spend a lot of time thinking about these FOMC statements, more than probably is optimal. Let's just be honest. I mean, we're in extremely unusual circumstances the past 2 years. The shocks from the supply side, the demand side, globally. I should always reiterate all the things I'm talking about. These are happening in most other countries around the world in different ways. So these have been very challenging. I always kind of think, should you be more transparent about how we're thinking about it and how we're making the decisions, or should you say, hey, we could be wrong, and so I don't want to go there? So on the transitory, I would say this was the assessment, whether the word was a good choice or not, that's not for me to judge. But there was an assessment that the primary factors that we saw influencing the inflation outlook were driven by the very things that we talked about this morning, about COVID, around supply chain issues, the chips and things like that. We saw them in the used car prices, which like all of us became experts at understanding the used car market last year. So that was the assessment, that was driving the decisions. And that we got to be data dependent. The data turned a different way, and we adjust. So to me, transparency and openness about the story that the kind of analysis we're doing, I think does make monetary policy more powerful. What's the price? Well, you're going to be wrong, and you're going to have to change course. And I think that as policymakers here and around the world, we all have to own that. That's part of the accountability we have. That was the assessment. New information has come in. We've reassessed. I mean, we talk about pivots. I would go back to last, October, November, where really, I would say the kind of recognition that the data were coming in differently. Obviously the taper decisions, and shifting the stance of policy was happening, back then. And then as the data continued to accumulate in ways that were surprising, then obviously communicate what we're seeing now. The word transitory, I think, is tough because, mathematically, it's either I0 or I1. It's either transitory or permanent, and clearly we don't see these things as permanent. But transitory meant a lot to a lot of people, unfortunately, 3 or 6 months, and clearly we're thinking longer. So it's a lesson learned. Worked on FOMC statements a long time. We've gone through the thesaurus, considerable period, measured pace, all the things. You go through these words, and one of the things that you'll learn, because I've been involved in FOMC since 18 years. It's once you use a word, everybody asks you, what do you mean by it? Measured pace. Like, what does measured mean? Well, if you look at measured, it means like deliberate and well-reasoned. They're like, oh, we're going to do unmeasured this year. But you use these words, and once you've used them, they have a meaning. and you can't use them again. So we have a trash can of all the things that you can't say. And, I guess, transitory, had that thing. It's like, this is something that we think is going to affect the economy for a while, but it's not going to be forever. But as the situation changes, I don't think it rang true. I do think, again, I'll defend the economic projections. It does put numbers to things. We say, this is what we mean. This is what we expect inflation to be next year. Of course there's uncertainty. Of course our forecasts aren't, we can't predict everything in the future because shocks happen. And, there's always uncertainty about that. And we should be, and I think we're much more transparent about the uncertainty bands around our forecasts. But I think, you kind of have to just, if we're making decisions based on a view of the economy, we just need to explain it the best we can and then continue to evolve. Thank you.
Thank you so much, John, and thank you to everyone, all of our speakers today, Mark for the outlook, and David, Elaine, and Eric for the panel, and thank you to John again for the really terrific closing remarks. A few more thank yous before I let you go. Thank you to Dana and Kathleen, as always. I don't want to speak for Steve, but I always feel like a bit of a figurehead because they really do run the show and do such a great job. Also, thank you to our Thank you to the amazing staff we have here at the Rabinowitz Simpson building. They work so hard, often behind the scenes, to make sure these events go off without a hitch. So thank you to our staff. Before I let you go, just a few notes about what we have ahead in terms of our programming. This coming week, April 6th, we have a book talk with historian Nicholas Mulder. We actually had this on our radar a few months ago, but it didn't seem quite so policy relevant. His book is on the rise of sanctions as a tool of modern war, which has suddenly become quite policy relevant, so we were able to get him to do a talk. Dana, is it also online? Okay, so you should have gotten an email about it, and we hope to see you either in person or online. It should be, sadly, quite policy relevant, like I said. After that, on a happier note, our reunions will be in person again, unless something very unexpected happens. Princeton reunions will return to be an in-person event after 2 years of absence. We will have a reunions event on May 20th. Our current research scholar, Carolyn Wilkins, along with one of our alums, Dan Moorhead, will be talking about the future of digital currency and the blockchain. So I know that's always that topic brings out a lot of people, so hope to see many of you at reunions. And then looking ahead to the fall, we don't quite yet have a date pinned down for the fall symposium. There's going to actually be 2 events related to the fall symposium, which will both be related to the challenges of climate change. We will have a special dinner, kind of not our typical just 2-day symposium. There's going to be another day where we have Lord Nick Stern from the UK on October 11th doing a talk and a dinner. His being one of the pioneers in terms of getting economists to think really hard about the challenges of climate change. So we will give you more information when we get the rest of the symposium scheduled, but please, look out for that. And in the meantime, I'll just say thank you once again to all of you, to our members in particular, for supporting us over the last 2 years, especially with our online programming. It was such a pleasure seeing all of you for the first time in 2 years in person. Hope to see you again soon, and enjoy the rest of this beautiful spring day.